Welcome back. In this lesson, we discuss the various types of financial intermediaries and the services they provide. Let's begin. In any market, there are buyers and sellers wanting to trade with each other. Financial intermediaries stand between buyers and sellers, facilitating the exchange of assets, capital, and risk. Their services allow for greater efficiency and are vital to a well-functioning economy. Financial intermediaries include brokers and exchanges, dealers, securitizers, depository institutions, insurance companies, arbitrageurs, and clearinghouses. Let's start with brokers and exchanges. Brokers help their clients buy and sell securities by finding counterparties to trade in a cost-efficient manner. They may work for large brokerage firms, for banks, or at exchanges. When the trade size is very big, block brokers help with the placement of such trades. Typically, large trades are difficult to place without moving the market. For example, a large sell order might cause the security's price to decrease before the order can be fully executed. Block brokers help conceal their clients' intentions so that the market does not move against them. Investment banks are also considered a form of brokers, as they help corporations sell common stock, preferred stock, and bonds to investors. They also provide advice to firms, notably about mergers, acquisitions, and raising capital. Exchanges provide a venue where different parties can trade with each other. They sometimes act as brokers by providing electronic order matching. Exchanges are easily distinguished from brokers by their regulatory operations. Exchanges regulate their members and require firms that list on the exchange to provide faithful and timely financial disclosures to allow analysts to value the securities issued by them. This levels the playing field for all participants as they all receive the same information at the same time. Exchanges acquire their regulatory power through the member agreement or from their governments. Alternative trading systems, ATS, serve the same trading function as exchanges, but have no regulatory function. They're also known as electronic communication networks or multilateral trading facilities. Many ATSs are known as dark pools because they do not display the orders that their clients send to them. Large investment managers especially like these systems because market prices often move to their disadvantage when other traders know about their large orders. So in general, brokers and exchanges facilitate trading through various means. They do not buy or sell the securities from the traders, nor maintain an inventory of securities. Dealers, on the other hand, buy and sell securities directly from the traders, and they do maintain an inventory. Dealers provide liquidity in the market and profit primarily from the spread between the price at which they buy, known as the bid, and the price at which they sell, known as the ask price. Some dealers also act as brokers and vice versa. They are termed broker-dealers. When a client enters an order, broker-dealers can choose to broker a deal with a counterparty or buy or sell the security directly from the client. However, there is an inherent conflict of interest. As a broker, it should seek the best prices for the client, but as a dealer, its goal is to profit through prices or spreads. As a result, traders typically place limits on how their orders are filled when they transact with broker-dealers. Securitizers are intermediaries that pool large amounts of securities or assets and then sell interests in the pool to investors. The cash flows that go into the pool, net of the securitizer's fees, are passed through to the investors. Commonly known as asset-backed securities, they are commonly segregated into multiple categories called tranches. The senior tranches provide the most certain cash flows, while the junior and subordinated tranches have greater risk. This form of securitization allows investors to invest according to their required risk and returns. Also, by splitting up the pool into many units or shares, the minimum investment amount is lower, giving access to a larger number of investors. Besides, there are diversification benefits in pooling assets together. Cash flows get more predictable, and liquidity is improved as the securities are more easily traded. There are also economies of scale in the management costs of large pools of assets and potential benefits from the manager's expertise in selecting assets. Assets that are often securitized include mortgages, car loans, credit card receivables, bank loans, and equipment leases. Some asset-backed securities are securitized by firms which set up a separate legal entity known as a special purpose vehicle to buy some of its assets. This removes the assets from the firm's balance sheet and may increase their value to investors as the assets are now bankruptcy remote from the originating firm. This means that creditors of the firm cannot lay claim to the assets sold to the SPV. Asset-backed securities are described in detail in the course on fixed income. Now, a form of financial intermediary that we are well familiar with is depository institutions, or what we commonly know as banks. Banks take on customer deposits, pay interest on them, and provide transaction services such as checking accounts. They then make loans to various borrowers with the funds, who pay interest on their loans, which forms the cash flows for the bank to pay interest on the deposits. Most banks have expertise in evaluating credit quality and managing the risk of a portfolio of loans of various types. Other intermediaries, such as payday lenders and factoring companies, lend money to firms and individuals on the basis of their wages, accounts receivable, and other future cash flows. These intermediaries often finance the loans by issuing commercial paper or other debt securities. Securities brokers provide loans to investors who purchase securities on margin. When this margin lending is to hedge funds and other institutions, the brokers are referred to as prime brokers. Regardless of the type of depository institution, the deposits from the depositors and the debt from the lenders can be considered the liabilities of the institution in its balance sheet. There are also stockholders who supply capital to institutions, and this forms the equity capital. The stockholders absorb any loan losses before the lenders and depositors. As such, the more equity capital the institution has, the less risk for depositors. Insurance companies are also intermediaries that we're familiar with. They collect insurance premiums in return for providing risk reduction to the insured. The insurance firm can do this efficiently because it provides protection to a diversified pool of policyholders whose risks of loss are typically uncorrelated. This provides more predictable cash flows compared to a single insurance contract, much like that of a bank's diversified portfolio of loans. Insurers are financial intermediaries because they connect the buyers of their insurance contracts with investors, creditors, and reinsurers who are willing to bear the insured risks. The buyers can be seen as transferring their risks to the investors who are willing to assume such risks for some returns. Insurance companies provide a benefit to investors by managing the risks inherent in insurance. Moral hazard occurs because the insured may take more risks once he is protected against losses. Adverse selection occurs when those most likely to experience losses are the predominant buyers of insurance. The insurer also has to protect itself from fraudulent claims, where the insured purposely causes damage or fakes losses so he can make an insurance claim. Arbitrageurs trade when they can identify opportunities to buy and sell identical or essentially similar instruments at different prices in different markets. They profit when they can buy in one market for less than they sell in another market. Arbitrageurs are financial intermediaries because they connect sellers in one market to buyers in another market. Don't confuse arbitrageurs with dealers. Dealers are intermediaries that connect buyers and sellers that arrive at different times in the same market, whereas arbitrageurs connect buyers and sellers that arrive at the same time in different markets. The purest form of arbitrage involves buying and selling the same instrument in two different markets. In markets with good information, pure arbitrage is rare because traders will favor the markets with the best prices. More commonly, arbitrageurs trade securities or contracts whose values depend on the same underlying factors. For example, when the call options on a stock are overpriced relative to the underlying stock itself, an arbitrageur can exploit the pricing difference by selling the call option in the derivatives market and buying the underlying stock from the stock market. While intermediaries like brokers, dealers, and arbitrageurs connect buyers and sellers directly or indirectly, the final settlement of trades is the role of another intermediary called the clearinghouse. Clearinghouses act as escrow agents, transferring money from the buyer to the seller while transferring securities from the seller to the buyer. In future markets, they also guarantee contract completion, making sure that both the long and the short fulfill their contractual agreement. For margin trades, the clearinghouse ensures that they post sufficient margin and limit the aggregate net order quantity of the members. Through these activities, the clearinghouse limit counterparty risk, which is the risk that the other party to a transaction will not fulfill its obligation. In some markets, the clearinghouse ensures only the trades of its member brokers and dealers, who in turn ensure the trades of their retail customers. Custodians also improve market integrity by holding client securities. These services, which are often offered by banks, help prevent the loss of securities through fraud, oversight, or natural disaster. And that's all the financial intermediaries we have discussed. By facilitating transactions among buyers and sellers, financial intermediaries provide services essential to a well-functioning financial system. In our next lesson, we shall look at positions and leverage. See you again.